All right, good morning, Insignio family. Today's February 25th. We've got a 26th, February 26th. We've got a very special guest today with us, Daniel Nicholas from Harris Oakmark. Welcome to the show.
Thanks for having me, and thanks for your support.
Absolutely welcome. So you guys are a value manager, and it's been interesting last few years, just saying, hey, this time it's we're up.
Yeah.
This year seems like we're seeing some of the rotation that we've been looking for.
Wow, that's so refreshing to hear. So I've been with Harris Oakmark for 13 years. It wasn't until 2022 that I got my first call on US value. So we've had to be patient. This product has outperformed on a 3-year, 5-year basis,
Mhm.
but it's been difficult to outperform the S&P the last 10. Since the global financial crisis, people have just wanted growth or stability, and value's been kind of left to the side.
Interesting. It's quoted, it says, "This is the most interesting time for active value investing in a long time."
Yes. So I was just in Madrid. I had the honor to do an interview there as well, and basically wanted to make the case that the S&P is quite risky. So I think a lot of investors want US exposure, and they think that if they get an ETF exposure, all right, good. There's no risk there. I don't have tracking error.
Mm.
But the market right now is quite risky for valuation reasons, number one.
Yep.
Number two, it's risky for concentration reasons because the Mag 7's done so well. And number three, it's has style drift right now. Believe it or not, the S&P, if you just invest in the market, is giving you growth exposure.
Mhm.
So I think investors are way overweight growth. They're investing at 23 times earnings. Usually JP Morgan and others would say the next 5-year earnings would give you the next 5-year returns of 3%.
Mhm.
So, and then concentration, we're more concentrated in the top 5 since 1957. And remember, the 60s and 70s had these big themes like the Mag 7 and AI. It was called the Nifty 50.
Right.
And they weren't able to keep their big market cap weight in the index, even though they were nifty.
Mhm.
So I think it's a wonderful time for value because there's 493 stocks that have been left behind that we can pick from. And I think one thing I'd love to talk about today is that if you go value, you're not going X growth. There's actually just as much growth in those 493 stocks that you can exploit if you pick the right companies.
Sure. When we look at the Nifty 50 blow up and that subsequent 16, 18 years the market just went sideways,
Yeah.
there were still reasonable opportunities to be active and create alpha.
Yes.
Would you compare and contrast this cycle that we're going into? Are there some ways that it rhymes?
Yeah, absolutely. The cycle that I know even better was the 2000 cycle.
Mhm.
So we had the same portfolio manager, same investment team in place. So think of the year 2000, and we had the same level of growth outperformance versus value. So you can basically see 2 peaks on a chart that I can send you.
Mhm.
They look the same. Then you look at, well, what price were we paying for the 100th most expensive stock? And what price were we paying for the 100th cheapest stock? And those levels are exactly the same as 2000 as well. So we have the same amount of price outperformance, the same amount of valuation expensiveness.
Mhm.
And so we wrote a commentary in 2000 that we can share with the team that basically says, we want to invest in big businesses. We don't want to invest in big market caps. And so what we're seeing here today is that there's kind of a shrinking large cap universe. Everything is mega cap. And so you're going to see our fund look a little more mid cap today that we can exploit. We're going into mid and large cap names.
Mhm.
They're large businesses, but they're underappreciated. So it's another way to say, don't look at the benchmark when you build your portfolio, invest in the 55 stocks you think are going to provide for the clients over time.
These two themes hit squarely in our house view. I mean,
Oh.
we're screaming for small, mid, smaller cap, and
Yeah.
been, on the value rotation train for some time. So this is exciting. themes kind of, matching up.
Yeah, think about General Motors, biggest auto manufacturer in the United States, mid cap. Think about AIG, biggest insurer in the United States, mid cap. So it's just the market's out of whack. And sometimes that happens. And that's a perfect time for active managers to say, I'm not going to build my portfolio based on the weight and the benchmark. I'm going to build it based on conviction instead.
Amazing. Let's talk about holdings and where's the sweet spot for the portfolio.
Yeah, so right now, 39% in financial sweet spot. So music to my ears that you said now might be the time for value. The other thing that I've not heard in my 13 years here is financials. And we've been overweight since the global financial crisis in different type of measures.
Okay.
But today, because of the Trump trade, there's this view that there's going to be lower corporate taxes.
Okay.
There's going to be good fundamentals. With the yield curve being positive, tariffs maybe offset some of those corporate tax reductions, but maybe lead to higher yields longer term, maybe a little bit more inflation. So as financials reprice their book from low cost deposits to higher investment assets, they can get a margin for a change instead of just kind of a flat yield curve. The other things I would say quickly is just lower regulation is good for the multiple. These financials are trading at a big discount to the S&P, and then lower regulation will allow them to increase their dividends and buy back stock because they've gotten through the stress test. They've been fine. They're actually a lot less risky than people think.
Interesting. Do you think the market has already priced in some of this? I mean, who doesn't know the Trump trade? Who doesn't know that the yield curve is now, normally, is there still a trade left there for financials?
There is, but what we'll be able to do is go within the industries within financials. So out of the 39%, 10% is banks. And that used to be a much bigger percentage of our financials. But what's getting priced in because of the yield curve and the Trump trade is the financials are doing better, the banks specifically. So we're trimming those and moving into other areas. But there's bigger trends going on as well. So think back to 2022 and 85% of economists look for a recession. We got it wrong. But we bought capital markets companies then. And you remember private equity, private credit, there was a view that there'd be no capital markets activity. So we bought KKR, BlackRock, Goldman Sachs. Now we're trimming those names because that has been priced into the market. So we'll go where the headlines are negative, and then once they get priced in, we'll trim out of those names.
What could we expect as far as a number of holdings in the portfolio?
55 names is what we're aiming to do.
Okay.
What we're going to do is that's going to be about 1.8% average holding in the portfolio. And what we want is our top holding to matter. And so we'll use about 3.6%, kind of twice the weighting of the average weighting as our top holding. And then based on risk reward, we'll start to go down the list of our weightings. Our top 10 names will be about a third of the portfolio. So we are stock pickers. We've been doing it for 50 years. We want to maximize that impact to the portfolio. And so expect 55 stocks. We have about 120 stocks that we've approved as a group that we think are high quality and low price, but we want the 55 best of those 120.
What's a name that you're most excited about this year?
Yeah, so John Deere is one of the names that I think is interesting. I think another theme that clients will be interested in is AI, and AI adopters is the way that we'll play it as value investors.
Okay.
And John Deere, you wouldn't think of as AI, right? But think of a tractor and all the technology that they're putting on the tractor. They have great metadata that they can use AI to analyze the soil quality, how much fertilizer does the farmer need to put in, and how deep do they need to put the seed in to make sure the yield is really good? How much water do they need to put into the soil? And so AI is going to enable companies to become more efficient.
Sure.
And Deere is out of favor because of the ag cycle is quite weak. Many of your clients will know about Brazil having a drought and a flood back to back. And so it's been difficult for those farmers to buy more tractors and kind of get into their fields.
It's an interesting because we always hear disruptor, enabler, but down chain, the ones that are adopting it, that's brilliant in its simplicity.
And that reminds us of 2000, to your original question too. This is the same thing. We didn't buy Dell and HP back then, who were the
Mhm.
computer makers, but we bought Capital One back then, who was going to write loans more efficiently by using computers. We have Capital One again today. We bought it in 2022 for fears of a credit crisis.
Mhm.
It has credit card exposure, but they write high yield loans and subprime credit cards better than others because they use computers, they use AI. And so it's the same theme as 2000. And we understand people get hyped up on these themes, but there's, if you invest with good, strong management teams, they're going to figure out how to maximize their profits.
One big pitfall would be like value traps.
Yes.
How do you guys steer clear of falling into the classical value trap?
Yeah, it's a great point. So I think the market has moved to you're only allowed to invest in certain type of companies if you're a value investor. So you have the entire S&P, call it 500 stocks. You're only allowed to invest in, say, 250 of them, those that have low PE multiples relative to the market.
PE, low price to book.
Correct. And so we say back in 1976, when we started our process, any company can be a value company as long as it's cheap versus itself. Now, companies are cheap for a reason. I've talked about all these negative headlines, and we go to where the negative headlines are, but it's not enough for us to invest in a company because it's cheap, because it could be a value trap. So there's two other criteria we require first before we price a business. We're looking for a good business that's going to grow per share value. So we don't think growth is a type of company. We actually think it's a characteristic of all companies. Every company grows, it's just how fast do they grow and what price do you want to pay for that growth? So we'll own high growing businesses if they're cheap. We'll own low growing businesses if they're cheap. But if you have growth, time is on your side. That business is going to be growing and helping you avoid a value trap.
Right. Can you walk us through an example last year, maybe where you fell into the value trap?
Yeah. It happens from time to time. So Cisco Systems is a company.
Food or computers?
Well, we own the food now.
Okay.
Prior fell into the trap with Cisco, the computer router business.
Right.
So we had a new analyst join. We've studied our behavior, and we found that when new analysts join, they tend to have their highest conviction in first idea. They want to make a good impression.
For sure.
So we've studied that. So we said, all right, here's the first new idea. Let's roll with this. We have a fresh perspective. We hadn't owned Cisco for 15 years. And the view was that their core router business was going to improve. Huawei, in the support of the Chinese government, had taken a lot of market share. But as we kind of re-domiciled and re-onshored, we focused on routers with Cisco in the United States. They could take back some market share. And they had we thought, a good management team and a good plan to do that. Well, fast forward, we own about 3% of the stock of these companies. We get great access to management and the board. And we met with the CEO. And to be honest, we were unimpressed with his grasp of the fundamentals of the business.
Wow.
And so we said, all right, it's cheap, but it's not, we don't believe in the management's strategy to grow the business going forward. So we fell into that trap. We didn't lose money, but we said our thesis is violated. We have to sell.
Okay. And this is before you started adding any positions?
We had put it in the portfolio.
Okay.
And we had met with management previously, and then the portfolio managers, CIOs, analysts had all started to meet with the management. They had made some acquisitions in the meantime, and we weren't happy with what their strategy was to make the acquisitions.
Well, it's better to know now than
Yeah, exactly. You can make a second mistake, right?
You could make a second mistake. Maybe the analyst should be on the management team.
Right.
This is more.
Yeah, and we do engage with them. So we send them a lot of letters and let them know what best practices are. So engagement to us is direct and private. You're not going to see us as an activist, but we get really good access to try to help these management teams.
Sure. Daniel, the process for picking stocks is mostly centered on U.S. names. Is that fair?
Correct. We have two investment teams. One is U.S. focused and one is international. So I can talk global as well if you want. But
wonderful. Where are you seeing valuations kind kind of dictate a better opportunity? Do you think it's international?
So we have a global Lux fund as well, and we have the US right now is 25% of GDP, but it's nearly 80% of the MSCI World market cap.
Right. That's a low number and a very distorted ratio.
Yeah. So is that the right number? We think not. So we would not want to be equal weight the US in a global portfolio. We'd want to be underweight it. We understand US exceptionalism, but what price are you paying for that?
Sure.
And so we would have more like 58 to 60% in the US, and then we'd have 40 to 42% outside the US, and primarily in Europe and European multinational businesses that just happen to be headquartered in Europe. So think Mercedes-Benz. The issue with Europe is it's half the price of the US. We think that the growth is not as strong, but it shouldn't be trading at half the price, and maybe a third of the price of the US. So a higher multiple, and the growth isn't as bad as people think, and the growth will improve if China improves. So if you think of a European company, only 29% of revenues come from Europe. So it's really a third North America, a third Europe, a third Asia. But we have this theme that you don't want any exposure to Europe.
Is it fair to say that in your bottoms up stock picking, day to day, you guys are at least macro aware?
It is. So I always say we got to put the macro and the micro. So tariffs comes up, and we speak to the CEO of General Motors, Mary Barra, and we say, well, what are you doing in case these tariffs come in with Mexico and Canada? It's the day before Trump received both of those, or at least paused for a month. And she says, I just talked to the president. This is what we would do in the short term. If tariffs go into effect for 30 days, it's going to cost us $500 million. So we could make more cars in Mexico and just park them there, and then we'll wait for the 30 days to lapse, and then we'll ship them.
Okay.
So
great.
we talk to management about what they're going to do. So you got to take the macro and put it in the micro. And so we've reduced our estimates for GM, but love the news today that they're buying back shares. So the stock's trading at 5 times earnings. The market's 22 times earnings. So it's 1/4 of the market. So a lot of these risks of macro are priced in.
Yes.
Now, we don't think it's an average business. An average business would be 22 times earnings. We think it should be priced more like 8 or 9 times earnings. And so a cyclical business will get a low multiple in our valuation. But a beautiful business like a Visa MasterCard, where you have secular growth, we're all moving from cash to credit. That's a above average business growing faster than the market. That should get a higher multiple. So our job is to be accountants and to kind of price cash flows differently.
Do you create a ranking system for all the stocks based on the criteria that you're looking at, and just keep tabs, keep score on, one stock versus the other? Is that how it shakes out?
Yeah. We're always telling stories. We're always comparing businesses against similar businesses. It doesn't have to be the same industry. Intercontinental Exchange is in the portfolio. It owns the New York Stock Exchange, and it owns the carbon credit trading mechanisms in Europe. But when we look at our risk model, it trades like a consumer staples. And so we look at other staples businesses that have recurring revenues and fees to try to figure out how we should price that business. And so we're always ranking our businesses, but comparing them through metaphors to similar attributes, but not just by sector or industry. But I think what's important is we have 20 analysts that are generalists, and we give them the autonomy to go in the United States and find what they think is value. So we're able to attract really senior analysts that stay with us 15 to 20 years, because we don't tell them the exact attributes they have to look for. We want them to make us jealous and be creative. So we bought Netflix in 2012 when they were building their moat. Value investing used to be cash cows. That's all you can buy.
Right.
Well, they had not much cash. They were kind of poor in profitability. They were building this network that we thought they could monetize over time. And we thought if they raised prices to what we pay for SiriusXM or other subscription models, the profitability would be good in the long term. And ultimately, that's what they've been doing. So we give the analysts the power to look at any company and value it in any way, not just using kind of one metric like PE or price to book.
Awesome. We are coming up towards the end of our session. I wanted to leave you with last thoughts and closing remarks for ways for us as clients to think about Harris Associates, Herrick Oakmark.
Yeah, fantastic. Thanks for having me again and for your support. First, I would just say that there's kind of a misnomer that if you go value, you're not going to be in the fun parts of the market. And I would say the growth is still there to exploit for active managers. You want to add a little value to your allocation because a passive allocation is growthy right now. You want to get those clients that blend exposure. And we think it's quite risky to be passive right now, even though that's a misnomer as well. And we've been doing this for 50 years. And basically, it's a library at our shop. We're talking to management teams. We're engaging with them. We know the quality businesses we want to own. And then we're just waiting for the market to give us these negative headlines that we can exploit, where any business can be cheap versus itself. And right now, we have twice the level of new idea activity than we usually have.
From your 20 generalists.
Exactly.
Okay.
It's even though the market's making new highs, the market making new highs happens about 50% of the time. That's not a time to sell. It's actually the opposite, we think right now. We think that it's a lot of things have been left behind that we can go and find and put into the portfolio.
Exciting stuff. Most of your team sits where?
In Chicago in one office.
Okay.
So as generalists, we'll have not just one person covering a financial, we'll have 7. And that way they all come into the office and they debate each idea. And so we're not left to just one person's opinion. This is our team. And so that's why we think it's kind of repeatable. Irregardless, we do have star PMs, but it's not a star culture. It's an analyst culture looking for the best ideas.
And compensation is tied into performance for everybody. So
it is.
Imagine so. Okay. Yeah.
And then
wild guess.
Exactly. Well, you'll see on the product Natixis as well. So Natixis owns us. We have a partnership that's still endured for about 50 years. And if an analyst does good work, they not only get a bonus and a salary, but they become a partner, which can give them a owner-like economics in the firm. So Natixis allows us just to do value. That's all we do. We don't have to grow. We're a performance-driven firm with good client service, and then we think the clients will come after that.
Awesome.
Cool.
Daniel, great fun. Thank you for being here with us today.
Our pleasure. Yeah. Thanks for having me.
Thanks, everybody.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosure